Tomorrow we got the jobs report and we've already got a lot of information that's giving us clues to what we might expect tomorrow. And I brought in the perfect person. I brought in Jim Welsh from Macro Tides. You guys are going to, a lot of you are going to be watching this video ahead of the jobs report. So Jim, you should give us exactly the number of jobs that are coming out tomorrow so we can all bet on it. How about that?
Okay, so just some math here. There's 160 million people that are working in this country, Blake. 1/10 of 1% is 160,000 jobs. So let
You
me
got this. You got
let
it.
my, get which way is the wind blowing? No, the one thing I will say is, and we talked about this back in April and probably in May as well. I showed surveys of CEOs, and back in January, 60% of them were planning on increasing hiring in 2025. By April, that was down to 30%. So what's happening, the dynamic that's at play and been at play, is companies have pulled back on hiring. The key thing is layoffs haven't really materially increased. So, the longer the uncertainty with the tariff stuff goes on, this is one of the areas that uncertainty is going to express itself where, gee, we got fewer jobs being created. And so to me, the downward trend of job growth slowing over, let's say, a 3-month average, because you get these 1 month ups and downs, I think that trend is going to continue. The most worrisome thing could be is the next shoe to drop, if it does, will be an increase in layoffs. That hasn't been happening. Continuing claims are creeping higher, but that's another aspect of someone does lose their job, and instead of finding a job in 5 weeks, now it's taking 9 weeks. Does that tell us something about the overall health of the market, labor market? Yeah, a little bit. Again, it shows that companies are reluctant to add labor costs until they have a better idea of what, if they're involved with importing goods, how much it's going to cost them to import those goods. So that's the
So
dynamic that's at play. And I think it's going to continue until companies and CEOs have more clarity.
and just to sum it up for you before we get into this and into your charts that you brought, you think the risks are tilted more towards a weaker number moving forward as there's less visibility from a CEO point of view.
Absolutely.
Okay.
Absolutely. I mean, there are headwinds, the uncertainty being a big one. The tariffs at 10%, it's 5 times what they were in January. So we are going to see, I think we just got the last good inflation report with the PCE last week, because going forward, we've talked about this, the takeaway values from last year for May, June, July, and August are low, like 15 basis points or less. So that means any number that comes in on the CPI and the PCE that's above 15 basis points, guess what? The annual change in the CPI and PCE is going to go up. I think in the next 4 months, an increase of 0.3 on the annual increases would be actually a good outcome, because because it would reflect that the month to month numbers aren't running away,
Right. And
so
just so everybody knows, CPI is actually coming out next week. So next week will be
yeah, usually
we're gonna
mid-month. I don't know which day.
yeah.
um but anyway,
All right. Well, Jim, let me just grab that date for everybody. I believe it'd be the 11th, which would be next Wednesday. It
talked
is
about.
next.
Well, and the other
Yep.
thing too, remember what Walmart said, the CEO of Walmart said, yeah, we're getting some price increases in May, but there's going to be more in June. So I think that's when we get the June number in mid-July, that's where I think we'll see more of the tariff impact in terms of pricing kick in.
All
But
right.
I think, the number for May is going to probably be up a little bit. Gas prices have been behaving. That will help a little bit. Airfares have been coming down. That helps. But as we go out the next 3 to 4 months, I just think the trend in inflation is going to be higher.
All
So,
right. Well, Jim, I'm interested to see what you brought, and I know, the S&P has been stuck at the 6,000 level. The dollar still looks like it's weakening. So we got a lot to talk about. Let's jump into the
yep.
charts you brought initially, and we are going to jump over to this trade deficit chart.
Yep.
What is this about, and what are we looking at?
Well, just it's the impact that trade has on GDP. Since stuff that's produced overseas and imported into the US, they subtract that from GDP. So in the first quarter, you can see an enormous increase of imports. Why? Because companies were buying stuff and bringing stuff into the country to avoid the tariffs. Also, gold, there was a huge amount of gold that left Europe and came into New York. So that added to that huge increase in the trade deficit. Well, in the first quarter, that subtracted 4.9% for GDP. That's the main reason why GDP was negative, and I think it was a zero point 0.2 negative, was because of what happened with trade. Now what we've seen is imports have fallen off a cliff. That's why that line went up so much. And so that reversal, along with a big increase in personal income, which was up 0.8%, very healthy number in terms of buttressing consumer spending, both those things, and we're going to look at a second at the GDP now, but the trade number, that huge spike up, just means that all that negativity in the first quarter is going to be reversed in the second quarter. In addition, inventories did go up in the first quarter. I think potentially, Blake, we'll see a bigger impact of inventories adding to GDP in the second quarter. So one of the point of this trade deficit is that we've seen behavior being changed by the threat of tariffs, imposition of tariffs, and I referred this in my letter over the last month as the twilight zone of economic data. Because a lot of people, oh my God, if you're liberal, you want to criticize Trump, look at GDP decline, we gave him a great economy. Without, does he bear some, I guess, responsibility for that because of the tariffs causing this huge increase? But so my point is to try to provide some understanding of how they calculate the GDP number and not to get whipsawed by, oh my God, look at the GDP's down. Well, in the second quarter, it's going to be up way more than is true. And the next chart underlines that.
There you
So
go.
the Atlanta Fed does a GDP now. And so, the Commerce Department provides GDP numbers, every 3 months. And then they have a first estimate, a second estimate, and then the final number. And even the final number gets revised a year from now. But the Atlanta Fed does, as new information comes in, they update their GDP estimate. So if you really want to keep track of ongoing data and how it may be impacting GDP, the Atlanta Fed GDP Now is a good source. What this shows is over the last 2 weeks, they had GDP running, you can see basically a straight line at about 2.1% or so. And then all of a sudden, now it's 4.6. How did that happen? Well, personal income was up 0.8%. So that means future consumer spending will be buttressed. And then the trade swing that we've just discussed. Is the economy growing at 4.2%? Absolutely not. But that headline, you can be sure, when the first estimate of GDP for the second quarter comes out, probably by the end of July,
Yeah.
President Trump will be all over that.
Yeah,
Oh,
sure.
it's all working. You didn't hear much about the first quarter when the tariff stuff caused GDP to contract, but we'll hear a lot, I'm sure, when the next number comes out because it'll be something that he can embrace.
That does make sense. All right. Well, yesterday we got the ISM Services data. So what did you extract from there?
Well, again, I think I want to be cautious in terms of, okay, it's below 50, which means contraction. About 80% of our economy is services. So manufacturing is less than 15. So that proportion weight of services, and all of a sudden now it's declining. And we can see since late last year, it has been working its way down from over 55 to under 50. That all said, Blake, I don't want to oh my God, look at the sky's falling, because people's behavior is being changed by the prospect of tariffs. And that uncertainty is causing, I think, a lot of companies just to move more slowly. And so, is this in and of itself, is this a positive for the economy? Of course not. The other thing is shown up in prices. And we can see since the end of last year. Now, this is a diffusion index. So they asked 100 people but I don't know what the actual number is, but I'm using as an example. You ask 100 people and 69% say, yeah, we're seeing higher prices. 69% of the 100. Well, that's how this number is derived. So they have a pool of ISM companies they contact every month, and 68% or whatever, 68.7 said, yeah, we're seeing higher prices. So again, we're seeing companies in the Cleveland Fed president said that in her conversations, what she's hearing and seeing is that companies that aren't even importers are raising prices incrementally because they know some of their competitors who do import stuff are raising prices incrementally. What companies want to do, Blake, is avoid a one-time big increase. In other words, we'll nudge it up little bit by little bit so that we can avoid doing that and also shocking consumers or businesses by a big increase. But the bottom line here is, as I've been saying, we're going to see inflation head higher, and I think the ISM Services number, front runs, if you will, what we'll see in a few months from the CPI and the PCE.
All right. Well,
So all of this means is, you're going to get a strong GDP number. Inflation is ticking higher. You think the Fed's going to be in any hurry to cut rates? No. And Trump badgering Powell and the Fed to cut rates, to me, just raises the bar because they want to avoid being political. And so when he's browbeating them, they're going to need real economic slowing in the economy to provide them the public reason for cutting rates. And obviously, if inflation ticks higher in the next few months, that's not going to provide it. It will take a meaningful increase in layoffs to get the Fed off the fence.
all right. Well, maybe one of the things that will get the Fed off the fence is going to be the recession odds.
Well, what we can see is since mid-April,
If recession odds are falling, then
that's
the Fed
another reason
can.
why,
Okay.
most economists are like, okay, Trump has backed off those crazy, ridiculous tariffs. Is that a good thing? Yeah. But as I note, 10% tariff is 5 times the 2% it was in January. But my point is that when the tariffs were rolled back, you can see people were very worried going into early May. Oh my God, we're going to head it for a recession in April, I should say, really, especially. And so now the odds of a recession have, come down quite a bit from
Yeah.
near 70% to, I don't know, low 20s, 27%. All right. The opposite here is what we're seeing is the economic surprise index. And again, the way this is calculated is economists make estimates for various economic reports that come out every single month. If the number comes in below those estimates, the surprise index declines. If the numbers come in above the estimates, this number goes up. And what happens is after a window of time where the economy consistently is doing better than estimates, you can see what happened last year from mid-year through May or November of last year. The economic surprise just went straight up. Well, then what happens is economists start raising the bar. Well, I think numbers are going to be even better. And of course, that's just when the numbers start to come in a little softer. So to me, this is again another indication that the odds are we are going to see the economy slow in coming months. I don't think we're on the doorstep of a recession yet, but there are some headwinds that the economy is facing. And until all this tariff stuff is clarified and companies then are comfortable to make decisions, the same thing for consumers, you're going to have a bunch of people that are just sitting on their hands, more people sitting on their hands than they will once we know all that stuff.
All right. Well, I remember you bringing up the surprise index just a couple of weeks ago, and it was looking a little concerning. I mean, we were breaking out to the upside. And so,
Yeah.
are
Well,
you
that's a good thing. I
surprised?
mean, again, it's showing that the data was coming in better than expected,
Right.
you know. And so to me, I've shown this chart with the 10-year treasury yield and that there's a pretty good correlation with treasury yields going up. And think about it, last year, what did treasury yields do from August, September up until October, November? They went up a lot. I mean, the 10-year went up 100 basis points as the Fed was cutting 100 basis points out of the funds rate. So this correlation is pretty good. And if it continues to soften in terms of the data coming in, not as expected, that should be a tailwind for treasury yields coming down. And that's my expectation. I think we're going to see a modest decline in treasury yields over the next month or so.
Well, then I'm interested to see your TLT chart. But the first chart's going to be the
Okay.
dollar. So
Yep.
here's the dollar, Jim. How do you feel about the dollar at this moment?
I think near term it's going lower. I think we're going to get below 97, 92 to complete the five waves down from the high that we saw at 110.17. In the bigger context, as we've talked, the dollar peaked at 114.77 in October of 23. It declined to like 100 a number of times and then ultimately made it up to 110. So to me, the dollar is finishing the correction that began off the 114 and change highs. And what we're doing for, A down, B up to 110, this is wave C that's going to take us to a lower low. But from a multi-month standpoint, I think we're going to see the dollar bottom in the next 4 to 6 weeks. And then I think the dollar is going to have a fairly good rally. So that's where we're at. We've had 1, 2, 3. The bounce to 101.97 was wave 4 of this C wave. And as we reversed, I noted last week and showed it a chart of the dollar index that initial decline from 101.97 was down to the 98.69 was 5 waves. So for me, that provided convincing evidence that this overall pattern structure is correct and that we're beginning wave 5 and we had a bounce for wave 2 of 5 and now we're in wave 3 of 5. And I think, again, the dollar is dropping below 97.92, but rather than get overly bearish at that point, it'll be time to get bullish. And then once moving averages start to turn positive, to become more constructive on the dollar. This also means, the euro is likely going up to a new high.
Yeah.
But once the new high is achieved, I think we're going to see a significant decline in the euro as the dollar rallies.
And I know traders in the Forex analytics community know I've been eyeballing 116.50. If you go all the way back to 2005, those were like a very pivotal low. It's been a key pivot for the last 2 decades. So you
Yeah,
you
yeah.
you you think about 116.50 is above new highs. So if the dollar hits new lows, what Jim's warning you is be real careful trying to FOMOing it lower, right, Jim?
Yeah, yeah, yeah,
All
yeah.
right.
And the other thing, I'll have to look at the euro chart and maybe I'll include it next because this five wave down in the dollar, I'm sure if we look at the euro, we can count 1, 2, 3, 4, and now the euro's in wave 5 itself. And once 5 waves are in place, whether a market's been trending up or down, you're going to get a reversal that retraces 38 to 618 or more of the prior move. And so that to me is what's developing here. The dollar is going to make a low, and then it's going to have a move that retraces a good part and potentially all of the decline from 110. We don't know that yet, but that's a possibility, which means the euro, once it gets to 116.50 or 117.50 or whatever, in other words,
Yeah.
it might push a little bit higher. The euro is probably going to decline to 110, 109 would
All
be my
right.
guess.
Be interesting. It's going to be interesting. All right,
As
Jim.
always.
The next chart you brought is gold. Gold, just is trying to grind higher. How do you feel about gold where we sit now?
Well, as I noted last week, as the dollar had 5 legs down from that 101.97, gold had 5 waves up from the 31.27. So that to me, that solidified the idea that the decline from 34.96 to 31.27 was just basically an ABC correction, which means we're going to see gold surpass 34.96. I think we've begun that move. And I think your words of grinding higher, I think that's what we're going to see. I think gold is going to a higher high above 34.96. But if I'm right about the dollar index, gold gets to 3,600, whatever the number turns out to be. I think that's going to be another significant trading high. And I was bearish going into that 34.96, looking for a decline down to 3,100. Didn't quite get there, 31.27. This decline that I think is coming, Blake, if indeed gold gets above 34.96, the dollar bottoms, it's going to be a more significant decline in gold. It's
All
going to
right.
retrace a lot of the rally from 1616, which is where gold bottomed in September of 22,
Sure. Sure.
to let's say 3,600. That's $2,000.
That's
382 is $800, folks.
yeah,
So
that's a big retracement.
that'll be a big one, but we'll see. I mean, the way the patterns are unfolding in both the dollar and gold are really joined at the hip, and they're progressing as expected.
And just so everybody knows, I mean, if you're a gold bull, you don't it's not something you necessarily have to be concerned with right at the moment, but it's something that Jim sees in the future. So we have to just be
Hey, if you're a
cognizant.
long-term bull on gold, to me, all this is saying is if it gets up towards 3,600, whatever the number turns out to be, you might want to take some chips off the table
Yeah.
because whether it's 20% of your position or a third, but I think the odds are there you'll have a buying opportunity below 31.27 and maybe closer to 2,600.
Wow. All right.
That may
Well,
be
let's
6, 12 months from now, but that's my guess.
all right. Well, let's talk about TLT because you're telling us that yields are going to go down, so that means you're bullish TLT here.
Very, very short term. I
Yeah.
showed you a chart last week, like a 40-year chart of the treasury bonds. And to me, the message from that chart was we've begun a secular bear market in bonds. And refresh people's memories, from 1945 to 1981, treasury yields, the 10-year went from, I think, 1.5 to over 15. Then from 81 to 2020, it went from over 15 to 0.55%. I think that bull market ended in 2022 when bond yields have, jerked higher. That implies at some point in time in coming years, the 10 years going to make it to, I think, 7.5%. That's just a 50% retracement of the prior secular bull market. Very near term, I think we'll see, TLT continue to move up, make it towards 89.50, 90.21. But to me, the way the bonds are acting, the discussions regarding the budget deficit, all those things combined, and we're going to see inflation start to tick up. The first month, I think people will ignore Blake because, oh yeah, we all knew that. But we get to September when it'll be 3 months in a row when inflation's heading higher.
Yeah.
We'll see how the bonds handle that.
Right.
So, you know, so longer term, I'm really very negative. Near term, I think it's going to get a rally. As I noted, the RSI confirmed that most recent low when the TLT traded down to 83.29. What I have found is over many years, the best rallies in bonds and in TLT happen when they make a lower low price wise, but the RSI diverges. And this confirmed, which just adds a little bit more evidence, if you will, and weight to the idea of, okay, we're going to get a near-term rally, but I'm not sure this is going to be a very dynamic rally.
Got it. Okay. All right. Well, the last chart you brought is the one probably most people are waiting for. S&P is sitting at 6,000. I think it looks like a bullish wedge. It doesn't look bearish. And my two senses here, Jim, is there's a lot of people that are sitting on the sidelines. They have missed the rally because, the whole tariff risk. But I mean,
Yeah,
what
no,
do you
I
do?
think that's part of it. I mean, positioning is a huge, important factor in every market. And positioning, when it starts to get extreme, either everybody's in long because prices can only go up. That typically happens after something's already been going up for many months, or oh my God, the sky's falling and I'm short and I'm going to really make hay. Also happens after something's been going down for a while. The abrupt nature of the decline that we saw going into the April lows, I think and the reversal that has happened pretty quickly. So for
Yeah.
institutions who still think, hey, we're not out of the woods with the tariffs, is that a correct statement? Absolutely. Is inflation going to tick a little higher? Yep. Is the Fed cutting rates anytime soon? Nope. So those are some of the reasons why I think there's been a reluctance to embrace the rally with both arms. The pattern suggests is from that low, we see one up, two down, three up to that 59.68, a three-wave pullback for four. And what we talked about last week is I think we're going to a higher high, at least above 59.68. We've done that. And I think when everything is said and done, my expectation is the S&P will get above 61.47. And when we get that new high, if and when that happens, I think potentially I'll become much more cautious. The advanced decline line warned us, and we talked about this for a number of weeks in February, that the market was vulnerable to a good-sized decline. Well, the ED line just made a new all-time high on May 19th.
Yeah.
So to me, that implies that the trend is up. Breadth is, at least earlier, was positive by a decent amount so far today, even with the S&P down a little bit. So again, the overall take here, Blake, coincides with your assessment that the odds are the trend is higher. And I think we're going to new highs. And if and when that happens, depending on how everything looks, I think potentially either a decent sized 5 to 7% pullback happens, or something much worse. Some of that will be dependent on obviously what happens in the bond market.
Sure.
And obviously the tariff show. I mean, July 9th comes up. Is President Trump going to, okay, for the countries where they're, in his view, negotiating in good faith and making progress, I'm extending the grace period beyond July 9th for them. But for countries that maybe there aren't much progress, well, we know what he's going to do. He's going to take out his sledgehammer and bludgeon some people. Okay, now we're back to 50%. In the markets, if that happens, the markets aren't going to like it.
Yeah.
So unfortunately, we're in an environment where it's a fluid situation.
It is. And we're at the mercy of this trade war.
Yeah,
So
squeeze.
right.
Yeah.
So Jim, I want to thank you for spending time with us. Before I let you go, a couple of things. Make sure you reach out to Jim Welsh to get his most recent macro tides. I got it this week. What's your email, Jim?
Jim Welsh, macro at Gmail. Happy to send you this month's macro tides. I cover a lot of stuff in this, a lot of nice charts, some of which go back decades, which to me is always kind of cool. So
Yeah, absolutely.
I hope somebody takes it up on the offer.
All right. And then Jim, what is your non-farm payroll guess tomorrow?
118.
118. That's not very exciting. I was negative 118,000.
Plus or minus 100,000.
Oh,
No,
come on.
no,
All
no.
right.
Well, again, to me, guessing the non-farm payroll is one of the most stupid endeavors anybody can do, because I pointed out 0.1% of 160 million people working is 160,000 jobs. And look at, the people whose business is to calculate that. Think about how enormous the revisions have been over the last 2, 3 years to whatever number they say. And yet markets are going to react to that number tomorrow, Blake. And when the revisions happen 6 months from now, and sometimes the revisions are very significant, it's kind of like, well, if the accurate number had come out, the markets probably wouldn't have reacted the way they did.
Absolutely. Yeah.
So anyway, I'm going with 118. And if I'm even somewhere in the ballpark, believe me, I'll be bragging about it next week.
That's great. All right. Well, we like to make the guesses as fun as it is. Well, Jim, thank you for spending time with us this week. Good luck for non-farm payroll, and good luck for all of you guys and gals at home. And remember, if you like what you see here, make sure you give us a retweet. If you see us on Twitter or on X, if you see us on LinkedIn, give it a like. All those types of things really help what Jim's trying to do here. And make sure you subscribe to the channel and give him a big thumbs up. All right, Jim, thank you so much. Have a great week, everybody. Jim, I'll catch up with you next week.
Thanks, Blake. Same to you.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.